I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. 1. Technical analysis is a method of analyzing financial markets using price and volume data to identify trends and make trading decisions. 2. There are various types of charts used in technical analysis, including bar charts, candlestick charts, and line charts. 3. Technical indicators, such as moving averages and MACD, can be used to identify trends and confirm signals. 4. Risk management is essential in trading, and stop-loss orders can be used to limit losses. 5. Discipline and patience are crucial in trading, and a trading plan should be developed and followed. 6. Emotional control is important when making trading decisions, and traders should avoid letting emotions cloud their judgment. 7. Technical analysis can be used to identify entry and exit points in trades. 8. The psychology of trading plays a significant role in trading success, and traders should be aware of their biases and emotions. 9. The history and evolution of technical analysis is important to understand the current practices and methodologies. 10. Technical analysis is not a guaranteed method for making profits, and traders should continuously learn and adapt their strategies. Technical analysis is a method of analyzing financial markets that focuses on analyzing price and volume data to identify patterns and trends. This method assumes that the current price and volume of an asset reflect all the available information about it, including its underlying economic fundamentals. Therefore, technical analysts believe that by analyzing these patterns and trends, they can predict future price movements and make profitable trades. The goal of technical analysis is to identify key price levels and trends that can be used to make trading decisions. This includes identifying support and resistance levels, which are areas where the price of an asset is likely to experience a reversal, as well as trend lines, which represent the direction of the asset's price movement over time. Technical analysts also use various technical indicators, such as moving averages, MACD, and RSI, to confirm signals and identify trends. Technical analysis is often contrasted with fundamental analysis, which focuses on analyzing the underlying economic and financial factors that affect an asset's price. While fundamental analysis is concerned with the intrinsic value of an asset, technical analysis is more concerned with its market value and the psychology of the traders that trade it. Therefore, technical analysts often focus on short-term price movements and trading opportunities, rather than long-term investments. Overall, technical analysis is a popular method of analyzing financial markets, and it is used by many traders and investors to make trading decisions. While it is not without its limitations, technical analysis can provide valuable insights into market trends and help traders identify profitable opportunities. Technical analysis uses charts to represent an asset's price and volume movements over time. The most commonly used chart types are bar charts, candlestick charts, and line charts. Each chart type has its own advantages and disadvantages, and technical analysts choose the chart type that best suits their trading style and goals. Bar charts are a popular chart type that displays an asset's price movements over a period of time. They consist of a vertical line representing the trading range for the period and a horizontal line representing the opening and closing prices. Bar charts are useful for identifying trends and trading opportunities, as they provide a visual representation of an asset's price movements. Candlestick charts are another popular chart type that display an asset's price movements over a period of time. They consist of a body and wicks that represent the opening and closing prices and the highest and lowest prices for the period, respectively. Candlestick charts are useful for identifying trend reversals and can provide more information about an asset's price movements than bar charts. Line charts are a simple chart type that display an asset's closing prices over a period of time. They are useful for identifying long-term trends and providing a clear picture of an asset's overall price movements. However, they do not provide as much information as bar charts or candlestick charts and are less useful for short-term trading. Technical analysts use charts to identify patterns and trends in an asset's price movements. For example, they may look for support and resistance levels, trend lines, and chart patterns, such as triangles or head and shoulders patterns, that can provide insight into the asset's future price movements. By analyzing these patterns and trends, technical analysts can identify trading opportunities and make profitable trades. Technical indicators are mathematical calculations that use an asset's price and/or volume data to provide additional information about its price movements. They are used to confirm signals from other technical analysis tools, such as chart patterns or trend lines, and to provide insight into the strength and direction of an asset's price trend. Some common technical indicators used by traders include moving averages, relative strength index, RSI, and moving average convergence divergence, MACD. Moving averages are used to smooth out an asset's price movements over a specified period of time and provide a visual representation of the asset's trend. RSI is a momentum oscillator that measures the strength of an asset's price movements and can be used to identify overbought or oversold conditions. MACD is a trend-following indicator that compares two moving averages to identify changes in momentum and trend. Technical indicators can be used in a variety of ways to support trading decisions. For example, traders may use moving averages to identify trends and confirm signals from other technical analysis tools, such as trend lines or chart patterns. RSI can be used to identify potential reversal points or to confirm signals from other technical analysis tools. MACD can be used to identify changes in momentum and trend and to provide an early warning of potential trend reversals. It is important to note that technical indicators should not be used in isolation, as they can provide conflicting signals and may not accurately reflect an asset's underlying fundamentals. Rather, they should be used in conjunction with other technical analysis tools and with an understanding of the asset's underlying economic and financial factors. Overall, technical indicators are a valuable tool for technical analysts, as they can provide additional information about an asset's price movements and confirm signals from other technical analysis tools. However, they should be used in conjunction with other technical analysis tools and with an understanding of the asset's underlying fundamentals. Risk management is an essential part of trading and involves identifying and managing potential risks to minimize losses. One way to manage risk in trading is through the use of stop-loss orders. A stop-loss order is an order placed with a broker to buy or sell an asset when it reaches a certain price. The purpose of a stop-loss order is to limit losses by automatically closing out a position if the price of an asset moves against a trader's position. For example, if a trader has bought an asset and set a stop-loss order at a lower price, the stop-loss order will be triggered if the asset's price falls to that level, thereby limiting the trader's losses. Stop-loss orders can be set at different price levels depending on a trader's risk tolerance and trading strategy. They can also be adjusted as the price of an asset moves in a trader's favor, which allows traders to lock in profits while still managing risk. Another way to manage risk in trading is through position sizing. Position sizing involves determining the amount of capital to risk on each trade based on a trader's account size and risk tolerance. By managing position size, traders can limit the amount of capital they risk on each trade, which can help to reduce losses in the event of an adverse price movement. Overall, risk management is a critical aspect of trading, and the use of stop-loss orders and position sizing can help traders to manage potential risks and limit losses. By using these risk management techniques, traders can help to ensure that they are able to stay in the game and continue trading over the long term. Discipline and patience are crucial aspects of successful trading. Traders who lack discipline and patience often make impulsive decisions based on emotions rather than logic, which can lead to poor trading outcomes. To cultivate discipline and patience in trading, traders should develop a trading plan and stick to it. A trading plan should outline a trader's trading strategy, including entry and exit points, stop-loss levels, and position sizing. It should also incorporate risk management techniques, such as the use of stop-loss orders and position sizing, to manage potential risks and limit losses. A trading plan can help traders to stay focused on their goals and avoid impulsive decisions based on emotions or short-term market fluctuations. Traders should also cultivate patience in trading by avoiding the temptation to make trades based on short-term price movements or market noise. Instead, traders should focus on long-term trends and wait for trading opportunities that align with their trading strategy and risk management techniques. To cultivate discipline and patience, traders should also develop a routine and stick to it. This includes setting aside time each day to review market trends and analyze trading opportunities, as well as establishing rules and guidelines for trading. By establishing a routine and following it consistently, traders can avoid making impulsive decisions and maintain a consistent trading approach. Finally, traders should be realistic in their expectations and avoid chasing unrealistic profits or taking excessive risks. Trading involves both potential rewards and potential risks, and traders should be prepared for both outcomes. By maintaining a realistic outlook and staying disciplined and patient, traders can increase their chances of long-term success in trading. Overall, discipline and patience are essential qualities for successful trading. Traders who develop a trading plan, cultivate patience, and maintain discipline in their approach to trading can increase their chances of long-term success and avoid making impulsive decisions based on emotions or short-term market fluctuations. Emotional control is a crucial aspect of successful trading. Traders who let their emotions control their decisions are more likely to make impulsive and irrational trading decisions that can lead to poor outcomes. To cultivate emotional control in trading, traders should develop an awareness of their emotions and learn to manage them effectively. One way to cultivate emotional control in trading is to develop a mindfulness practice. Mindfulness involves cultivating awareness of the present moment and observing one's thoughts and emotions without judgment. By practicing mindfulness, traders can develop greater emotional awareness and learn to manage their emotions more effectively. Another way to cultivate emotional control in trading is to develop a set of trading rules and guidelines and follow them consistently. By establishing a clear set of rules and guidelines for trading, traders can avoid making impulsive decisions based on emotions or market noise. It is also important to remain disciplined and patient in following these rules and guidelines. Traders should also avoid making trading decisions based on fear or greed. Fear can lead to overcautious trading decisions that result in missed opportunities, while greed can lead to excessive risk-taking that can result in losses. By remaining objective and focusing on their trading strategy and risk management techniques, traders can avoid making decisions based on fear or greed. Finally, traders should learn from their mistakes and be open to feedback and constructive criticism. By reflecting on their trading decisions and analyzing their outcomes, traders can learn from their mistakes and improve their trading skills. Seeking feedback from mentors or other experienced traders can also provide valuable insights and help traders to identify areas for improvement. Overall, emotional control is a critical aspect of successful trading. Traders who cultivate emotional awareness, develop a set of trading rules and guidelines, avoid making decisions based on fear or greed, and learn from their mistakes can increase their chances of long-term success in trading. Technical analysis can be used to identify entry and exit points in trades, helping traders to maximize profits and minimize losses. By analyzing chart patterns, trend lines, and technical indicators, traders can identify potential trading opportunities and make informed decisions about when to enter or exit a trade. One way to identify entry points is through the use of chart patterns. Chart patterns are visual representations of an asset's price movements that can indicate a potential trend reversal or continuation. Examples of chart patterns include head and shoulders patterns, triangles, and flags. By analyzing these patterns, traders can identify potential entry points and make informed trading decisions. Trend lines are another useful tool for identifying entry points. Trend lines are lines that connect the highs or lows of an asset's price movements and can indicate the direction of a trend. By analyzing trend lines, traders can identify potential entry points and make trades that align with the direction of the trend. Technical indicators can also be used to identify entry points. For example, traders may use moving averages to identify potential support or resistance levels, or RSI to identify overbought or oversold conditions. By analyzing these technical indicators, traders can identify potential entry points and make informed trading decisions. In addition to identifying entry points, technical analysis can also be used to identify exit points. Traders may use trend lines or technical indicators to identify potential exit points and make trades that align with their trading strategy and risk management techniques. Stop-loss orders can also be used to limit losses and ensure that traders exit a trade when it reaches a predetermined level. Overall, technical analysis is a valuable tool for identifying entry and exit points in trades. By analyzing chart patterns, trend lines, and technical indicators, traders can identify potential trading opportunities and make informed decisions about when to enter or exit a trade. This can help traders to maximize profits and minimize losses, leading to long-term success in trading. The psychology of trading is an important aspect of successful trading. Traders who understand their emotions and biases can make more informed and objective trading decisions, leading to better outcomes. To understand the psychology of trading, traders should be aware of their biases and develop strategies to manage them effectively. One common bias in trading is confirmation bias, which is the tendency to seek out information that confirms one's pre-existing beliefs and ignore information that contradicts them. This can lead to poor trading decisions based on incomplete or inaccurate information. To manage confirmation bias, traders should seek out a variety of sources of information and remain open to new perspectives and ideas. Another common bias in trading is overconfidence bias, which is the tendency to overestimate one's abilities and underestimate the risks involved in trading. This can lead to excessive risk-taking and poor trading decisions. To manage overconfidence bias, traders should remain humble and objective in their approach to trading and avoid taking on excessive risk. Fear and greed are also common emotions that can impact trading decisions. Fear can lead to overcautious trading decisions that result in missed opportunities, while greed can lead to excessive risk-taking that can result in losses. To manage fear and greed, traders should focus on their trading strategy and risk management techniques, and avoid making impulsive decisions based on emotions or market noise. Finally, traders should be aware of the impact of stress on their trading decisions. Stress can lead to poor decision-making and impulsive behavior, which can lead to poor trading outcomes. To manage stress, traders should develop stress management strategies, such as exercise or meditation, and take breaks from trading when needed. Overall, the psychology of trading is an important aspect of successful trading. Traders who understand their biases and emotions and develop strategies to manage them effectively can make more informed and objective trading decisions, leading to better outcomes over the long term. Trading is a competitive and fast-paced environment, and it is important for traders to develop a mindset of continuous learning and improvement. Successful traders are those who are always looking to improve their skills, learn from their mistakes, and stay up to date with the latest trends and developments in the markets. One way to develop a mindset of continuous learning is to engage in ongoing education and training. This can include reading books and articles on trading, attending seminars and workshops, or taking courses on trading strategies and techniques. By staying up to date with the latest trends and developments in the markets, traders can identify new opportunities and make informed trading decisions. Another way to develop a mindset of continuous learning is to seek out mentorship or guidance from experienced traders. Mentors can provide valuable insights and feedback on trading strategies and techniques, as well as help traders to identify areas for improvement. Traders can also learn from their peers by networking with other traders and sharing insights and strategies. Traders should also be open to feedback and constructive criticism, as this can help them to identify areas for improvement and refine their trading strategies. By reflecting on their trading decisions and analyzing their outcomes, traders can learn from their mistakes and improve their trading skills over time. Finally, traders should cultivate a growth mindset, which is the belief that their abilities and skills can be developed through dedication and hard work. By embracing challenges and viewing failures as opportunities to learn and grow, traders can develop a mindset of continuous learning and improvement. Overall, a mindset of continuous learning and improvement is essential for success in trading. Traders who are always looking to improve their skills, learn from their mistakes, and stay up to date with the latest trends and developments in the markets can increase their chances of long-term success and achieve their trading goals. The final point of the book Technical Analysis for Beginners by A Z Penn is that traders should have realistic expectations about the returns they can generate from trading. Trading is a high-risk activity, and traders should be prepared for the possibility of losses as well as gains. Traders should be cautious of get-rich-quick schemes or promises of guaranteed profits, as these are often too good to be true. Instead, traders should focus on developing a consistent trading strategy, managing risk effectively, and maintaining a disciplined and patient approach to trading. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.